Thank you very much, everyone, for listening this evening. It's fallen upon me to try and make the case for investing in large cap companies. Hence the title here: "Who Says Elephants Cannot Dance?" What I'm going to talk about this evening, if we go to the next slide, is a few things. And point number one is that the future is inherently uncertain, as much as fund managers might pop up on the Today program and tell you that they know what's going to happen in the next 12 months. Believe me, none of them really can. I think the last year or so probably proves that. And therefore, we think a successful investment strategy is about tilting the odds in your favor, and I will talk about that. I'm also going to talk about trying to understand the source of your returns, and I'm going to talk a little bit about using base rates to try and help you with your forecasting. Beyond that, we're going to move on and show you how mature businesses actually can deliver attractive returns, so long as you buy them at low valuations and you basically allow them to compound over time. So if we move on, and I do apologise for doing this to you in advance, but I'm going to bring up this slide, Britain's answer to Warren Buffett, and I suspect you're all thinking we're talking about Terry Smith here. But unfortunately, no, we're talking about this man again. So you probably spent the last 2 years trying to forget him, and then his face comes up in the same presentation as twice in one evening. But there is actually a reason for this, which is that Neil Woodford is a man who actually built his reputation on investing in large cap companies and making a lot of money from it. If we go to the next slide here. These are actually Neil Woodford.
Sorry to interrupt you. We're just going to take control of the slides and we'll run them for you. Sorry to interrupt. Okay. So when you want to move on, you should just ask, we'll do it for you. Okay.
If we look at this slide here, we can actually see the returns that Neil Woodford had produced. This is at the end of 2011. If you look at the high income fund, over 15 years, that fund had produced 347%. Versus 42% for the FTSE All Share. And I think you'll agree, pretty outstanding returns if only he'd stuck to that strategy rather than trying to reinvent himself as an unquoted or biotech investor. What's actually remarkable about this is that he didn't do it by investing in small companies or growth companies or unquoted, actually. He did it by investing in large, boring companies. If we can go to the next slide. He basically got two big decisions correct. The first one was to avoid investing in technology companies in 1999. I think that's a pretty pertinent lesson for today. But the second thing that he did was that he invested in a lot of large, mature businesses, such as utility companies and tobacco companies, at a time that they were very, very undervalued. And actually made a fantastic return out of that. So British American Tobacco back in 2000 was actually at its lows. It was about £3.50 in the stock market. It went on to a share price of about £50. What's remarkable about this, you can see this in this slide here, is that not only was this a slow growth industry, it was a declining industry. If you look at the bar over the left hand side, even by 2000 we knew that cigarettes killed us. And so actually industry volumes were declining year on year. So how on earth do you make 20% annualized returns in an industry that's declining? Well, effectively, that's what we're trying to show you here. You can see that they grew a bit of market share, so their volumes grew a little bit more than the wider industry. They got some price and mix improvements. Their sales grew about 3% per annum because their sales went up faster than their costs. Their operating profits grew about 5% per annum. But this is where it gets really interesting. Because this company was a very cash generative company, and because its shares were very lowly valued, it used its cash flow to basically buy back its own stock. So it reduces the number of shares in issue, and therefore you see that a sort of 5% operating profit growth per annum turns into about 13% earnings per share growth, and actually that turns into 15% dividend per share growth. And then the final thing that happened, and this is very important, is at the start of this period, investors loved technology companies, hated old economy companies like this. By the end of this period, they actually changed their mind and they decided they liked companies like this. And so you've got what we call a valuation re-rating. In other words, the price earnings ratio went up, in the rating that investors were willing to put on it actually went up. So it's a fascinating story there. If we go to the next slide, we can see here that we also have achieved some pretty good returns from investing in these large mature businesses. This is the track record of the our longest running strategy, and you can see that over the time that we've managed this has delivered about 382% versus about 174 for the market by following a similar sort of strategy. Now, again, I'm going to take a bit of a risk here by trying to go through a little maths with you. I know on an online webinar, this is the point at which people basically leave and go and put the kettle on or go to the loo, but please do bear with me for a couple of minutes. It's not going to be that complicated. I think it's really important to try to understand where your total returns as an investor come from. And they effectively come from three places. They come from the income that your investment generates. They come from the growth in that income, and they come from any change in valuation. And that, of course, that can be positive or negative. In this case of BAT that we just saw, it was a positive. We go on to the next slide. We can see what this looks like for the stock market in the long run. Now, in the long run, the stock market has delivered you roughly 8% per annum returns, and you can basically break that down. 5% of that came from income, came from dividends that you were paid as an investor. About 2.3% came from growth, and that might surprise people that that's so low, because that's a nominal figure, by the way. So that growth is really only about in line with inflation, and the change in valuation very little. You know, obviously stock markets don't tend to re-rate or de-rate over time, so that tends to be around zero. And Warren Buffett. He has lots of good sayings, but one of his sayings that I particularly like is he says, I don't look to jump over 7-foot bars. I look around for a 1-foot bar that I can step over. And what he means by this is basically try to make life simple for yourself by just tilting the odds in your favor. And if we go back to our maths example here, there are different ways you can try to get to that 8% return. So you could buy a stock with a dividend yield of 5. You would only need, therefore, the growth in income to be roughly in line with the long run average of the market, and you wouldn't require any change in valuation at all. So that might be making 8% return the easy way. You could, of course, do this. You could make that same return the hard way. What I mean by that is you could buy a much more expensive stock, so a stock that's only paying you a 2% yield. You would then need the growth to be 6% per annum, and remember the average growth is about 2% per annum. So you would have had to have found a really special company here, and also you'd have to be sure that growth rate could sustain over the period that you owned it. Finally, you would need to be sure that there was no change in valuation over the time that you owned it. So that's potentially making that 8% the hard way. And I think this probably explains why a high dividend yield strategy in the long run has been a successful long-term strategy. This is the chart that every income fund manager tends to have in his presentation deck, and it basically just shows you that systematically buying high dividend yield stocks gives you a better return than the market or low yield stocks, making money the hard way. And when you compound that over long periods of time, it really does add up to a very substantial difference. I want to just drill down for a second on this issue of valuation, because I think this valuation is potentially an area that investors tend to neglect a little. When you buy an equity, you've always got to remind yourself that what you're doing is you're buying a claim to some cash flows in the future. And the higher the starting price that you pay for those cash flows, the lower your return is going to be. Now, just to try to make that point really simply, what we've done here is we've just said that with the cash flow effectively is £1 in 5 years' time. And then we've basically looked at the returns that you would get at different starting prices for that £1. So over on the left-hand side there, if you pay £1.10 for £1 in 5 years' time, clearly you're going to lose 2% per annum. If you pay £1 for £1 in 5 years' time, you're making nothing, and so on and so forth. If you're sort of clever or lucky enough to pay 25p and get £1 back in 5 years' time, then you're making an annualized return of 32%. So what we're trying to demonstrate there is that the lower the starting valuation you pay for a stream of cash flows, the higher your returns. And I think investors also tend to underestimate the impact of valuation change, and that's what we're showing you here. Just to explain a term here, what we're looking at here is a valuation measure known as free cash flow yield. What that is the free cash flow that a company generates divided by its market cap. Broadly speaking, the higher the free cash flow yield, the cheaper the stock. And so what we're doing is looking at the returns that you might get from a stock on a high starting free cash flow yield, which we call the value stock, and the returns on a more expensive stock, the growth stock. So if you start with the value stock, the free cash flow yield here is 10%, but because it's in a mature industry, we've given it no growth. So at that point of time, your annualized return is basically 10%. The growth stock is more expensive, that has a 4% free cash flow yield, but because it's in a growth industry, it's growing at 4% per annum. So your total return per annum there would be 4 plus 4, which is 8. So at this point in time, the value stock has a 2% per annum advantage. But now let's have a look at what happens if those valuations change over time. So let's say over the course of the 5 years that we own this stock, the value stock re-rates, so it goes from a 10% free cash flow yield to an 8% free cash flow yield. Not that much, you might think. But what's amazing is that actually adds, that re-rating adds 4% per annum. So we had 10%, we've added another 4%, we now have a total annualized return of 14%. Now let's look at what happens with the growth stock. If the growth stock goes from a 4% free cash flow yield up to a 6% free cash flow yield, amazingly, that loses you 8% per annum. So you had 8%, you lose 8%, you're at 0. So at that point in time, there's a 14% annualized difference between these two companies. You compound that over 5 years, that's nearly 100% difference. And what's remarkable is let's just remind ourselves, the growth stock had a higher growth rate throughout that period. It had 4% per annum. And at the end of the period, it was still more expensive. It was on a 6% free cash flow yield versus 8. So I think that's something that's just very important to bear in mind. And I think something that a lot of investors miss is the degree to which a change in valuation in either direction can really, really impact your returns. So what we're looking for is a low starting valuation. And of course, you know, the stock markets tend to be reasonably efficient. And so to get that low starting valuation, we need some sort of dislocation to happen within the market. We need something that makes people become fearful and sell shares for less than they're really worth. So less than, you know, their intrinsic value is another way of phrasing that. And let me give you some examples here, because believe it or not, this does actually happen quite frequently. If we start maybe with the most recent example, the bottom one here is Royal Mail. Believe it or not, in the middle of last year, Royal Mail bottomed at a share price of £1.30. In the year just finished, the year to March 21, it reported earnings per share of 60p. So at the bottom in April last year, you could buy Royal Mail on 2 times earnings. Think about that as an earnings yield. That's a 50% earnings yield. Of course, the shares today have gone on to about £5. I want to also go up to the top example, because I'm going to break down that into a little bit more detail. This is Next, the retailer, and the dislocation here is the great financial crisis. Amazingly, the share price there went from £24 in 2007 to a low of £8 in 2008, and that really is extraordinary, because you know this was a retailer, not a bank. There was no obvious reason why people should be so fearful about Next as a retailer, and it had a very strong balance sheet as well, so it wasn't going bust. And yet, if you look again at the lows there, the share price of £8 is about 4 times the trough EPS, the trough earnings per share of £2. So again, you had the opportunity to buy that at about 4 times its earnings, and of course, today the earnings are £4.30, and the current share price is nearly £80. So another great example. But the other reason that I think Next is really, really interesting is because, again, the returns from this company have been somewhat similar to the British American Tobacco example we looked at earlier on. So next, we're looking here at the period 2003 to 2013. And again, if we just go across the diagram here, the chart, we can see it's not a phenomenally high growth business. It grows its sales by about 5% per annum across this period. A bit like British American Tobacco, because its costs didn't go up as much of its sales, its operating profits grow by about 8% per annum. And again, very, very similar to British American Tobacco, because it generates a lot of cash and it bought back its shares, and its shares were very lowly valued. You can see that its earnings per share grew by about 16% per annum. So did its dividends per share. And again, you've had that re-rating. We've seen it, a couple of times now in the examples we've looked at, where at the start of the period, people didn't like this company. At the end of the period, they did. So it went from 10 times earnings at the start to about 16 times earnings at the end of the period. That re-rating drove that valuation. And last couple of slides, and then I will finish. But believe it or not, there are actually plenty of reasons that cause these sort of dislocations. We've given you some examples here. The economic cycle is one. The downturn in the economy last year gave you plenty of opportunities to buy good companies at low valuations. And we often can see the capital cycle, the credit cycle. Lots of different things happen that cause those dislocations. Of course, the challenge is actually having the sort of mental fortitude to take advantage of them at the time that they happen. And I would just finish by saying that I think that today you are actually being given some good opportunities to buy some very cheap companies within the UK market. This chart here shows you the valuation of the UK market relative to the world stock market. And what we can see is that the UK is the cheapest relative to the world stock market that it's been for 50 years. On average, across this period, it's traded at about a 17% discount. Today, we're at about a 45% discount to the world stock market. So that's, for a UK investor, that should be pretty interesting, because that potentially that gives you that low valuation entry point that we're looking for. If we actually look within the UK stock market, it's interesting how the market's become quite bifurcated between what we call value stocks, so some of these old mature companies, and growth stocks, the more exciting technology stocks, and so on and so forth. And that's exactly what the chart on the right hand side here is showing you the gap in valuation between those two groups of companies. Again, we can see that the average over the last 50 years is that value stocks have traded at about a 38% discount to growth stocks. Today, we're at about a 65% discount. And what's really interesting about this is you go back to 2000 and see what the margin, the gap was there. The gap there was about 55%. And as we saw earlier on, people who bought those stocks back then actually made some very, very attractive returns. Today's gap is even wider than it was back in 2000. So I think that's a really interesting entry point. So which companies have the potential today to be the sort of British American Tobaccos or the next of the next decade? And I've given you three examples here, and deliberately they are from the energy sector and the mining sector, and there is a reason for that. These are two sectors that are very unpopular with investors today, and they're unpopular for various reasons, but in a lot of cases it's for ESG reasons. Some fund managers have just simply excluded this sector and just won't own these companies anymore. They've been selling these companies from their portfolios, and you can see here what that has done. It's driven the valuations to very, very attractive levels. We're going to focus on that metric, free cash flow yield, that we used earlier on in our example. And just look at the free cash flow yields that are available in these companies. Royal Dutch Shell, 17%. By the way, this has a AA rated balance sheet. BP, 15%. Anglo American, 18%. You're getting dividend yields of 5%, but these companies also, recalling our BAT on our next examples, they're buying back their shares because their shares are very lowly rated. So you as an investor are getting a dividend yield and you're getting a share buyback as well. If you take a company like Royal Dutch Shell, it's estimated that between 2021 and 2025, it will have returned half of its market cap in cash flow to its shareholders. So some potentially very interesting valuations that are being that are coming available in the UK market today. And that concludes my presentation. I hope you found that interesting. I think that the couple of really strong messages I want you to take away is that yes, you can make money, good money, from investing in mature large cap businesses, but you need a couple of things. Number one, you need a low starting valuation that delivers those attractive returns. And number two, you need a company that has the ability to generate cash and use that cash wisely by paying it back to its shareholders and buying back its own stock. Thank you very much.